Somewhere in London right now, a small group of people are on a phone call. They are not elected. No government sent them. Nobody voted for them. And in about 15 minutes, they will decide what you pay for groceries next month. Not directly. They would never do it directly. That is exactly how this works. You know the stock market. Everyone does. It is on the news every night. Flashing numbers, nervous anchors, graphs going up and down. But there is another market, older than the stock market, bigger in many ways, and almost completely invisible to regular people. It is called the commodities market. And it does not trade apps. It does not trade companies or shares or tech startups. It trades the actual raw material of the world. Oil, wheat, copper, sugar, coffee, cotton, natural gas. The physical stuff civilization is built from. And here's the part that should genuinely bother you. Most of the people trading in this market have zero intention of ever touching the product. Let me take you back, way back. It is the 1840s. American farmers are growing corn, but they have a serious problem. The harvest comes all at once. Prices crash overnight. Then winter hits, and prices shoot back up. The whole system is unpredictable, chaotic, brutal. So someone came up with a solution, a contract. A farmer and a buyer would agree today on a price for corn that would be delivered 3 months from now. The farmer knows what he will earn. The buyer knows what he will pay. Everybody sleeps better. They called it a futures contract. Simple, practical, almost boring. But then the speculators arrived. These were not farmers, not bakers, not anyone who needed corn. But they spotted something. If you can buy a contract on the price of corn, you can buy and sell that contract before the corn ever actually arrives. You can bet on whether the price goes up or down. And if you get it right, you make money. Clean, simple, no corn required. Now, the farmers and real buyers are still in this market. They are called hedgers. They use it for exactly what it was designed for. But here is the number that matters. Today, for every one real hedger in the commodities market, there are roughly 9 speculators. 9 people with no product, no farm, no factory, just a position on a price. And this is where things get uncomfortable. When 9 times more speculation exists than actual commerce, the price stops being about real supply and demand. It starts being about what traders think other traders think the price is going to do, which sounds like an abstract problem until you look at 2010 and 2011. Global food prices hit their highest level in recorded history. The United Nations reported that 44 million people were pushed into extreme poverty in months, not because harvests failed, not because food disappeared, but because enormous amounts of investment money had rotated into agricultural commodities as an asset class. Food became expensive because food became attractive to investors. There is a word for this: financialization. It is what happens when real physical things, bread, oil, copper wire, get absorbed into the logic of financial markets. They stop behaving like goods that people need. They start behaving like assets that people trade. And once something behaves like an asset, its price is no longer just about how much of it exists or how many people need it. Its price is now about sentiment, about fear, about a Federal Reserve decision made thousands of kilometers away, about a hedge fund rebalancing its portfolio on a quiet Tuesday afternoon. Now, step back even further. This is not just about food. Oil prices feed into manufacturing, shipping, plastics. Everything moves by something that burns fuel. Copper prices drive construction costs and electronics. Natural gas sets the floor for home heating and industrial production. Every single price increase in this market travels silently through the supply chain and lands in your shopping cart 3 months later. You never see it happen. You just notice that things cost more than they used to, and you wonder why. Here is the question nobody really asks out loud. If a market was created to stabilize prices for farmers, and it now destabilizes prices for everyone else, at what point do we admit it is no longer working for the reason it was built. Nobody inside the market will raise that question, because for them, the market is working perfectly. The only question left is simple. Who exactly was this market designed to work for? And whether you are one of them.